Hi, welcome back. This is Super Macro Podcast 4. Today we will be discussing the US labour market and the outlook for rate cuts. I, as you know, am Elvis. Opposite me is Jonny Matthews, the heart and soul of Super Macro. Good morning, Jonny.
Morning, Elf.
Okay, Jonny, today we're going to discuss the US labour market and the outlook for rate cuts. Where do you want to start?
Well, let's talk about Friday's payroll print first of all. So let me just bring up the chart. It's the chart that viewers may be familiar with, where I split the payroll gains into cyclical and non-cyclical. And it's the same story for a fourth consecutive month. Healthy gains in cyclical sectors, 303,000 total. And there's nothing to dislike about this labour market report. Unemployment ticked down to 3.8%. More people entered the workforce. Average hourly earnings was 4.1% year on year. The working week ticked up. People were worried about the working week declining recently. Now it's ticked up again. So there's really very little to dislike about this. And I didn't put the 3 and 6 month moving averages of payroll growth, but you can see, you just need to glance at the chart and you can see that payroll growth has picked up quite dramatically in the last 4 months. We went through a soft patch in October and November for some reason, and now it's picked up again.
This looks all very solid. I can see that from Deck 23 through to now. It looks all very solid with cyclical gains as well. But it's something I've noticed on Twitter, people have been talking about this, is the proportion of part-time jobs to full-time jobs that are being created, i.e. full-time jobs being lost. I saw one of the charts said over 10 months, 1.8 million full-time jobs have been lost. I can't confirm that's what I've seen. And basically, it's all part-time jobs. Are you concerned by that? That it's all part-time jobs that are being created as opposed to full-time jobs? Or what do you think?
First of all, before I get into this, I just want to say, like we discussed a couple of weeks ago, there's always people, I mean, it's been the same story for the last couple of years, where people are saying, oh no, we're going into a recession. There's this signal, there's that signal, whatever it is, whether previously it was the NFIB small business survey that supposedly signaled the direction of payroll growth with a 4 month lead. Well, that's still heading south and payroll growth has picked up. It's the same with a lot of these forward-looking indicators. They work for a short period and then they stop working. So people look at the actual labour data and try to pick holes in it. And what you're talking about, I think, is this chart here. Okay. So this shows, now the blue line is US full-time employment on the left axis, and the red line is part-time employment, which is on the right axis. So full-time employment has come down a little bit, but it's still something like 132 million people in full-time employment. Part-time employment has been going up and up since the pandemic. And if you look at the most recent period, you can see there's been a slight decline in full-time employment and an increase in part-time employment. That's, I presume, what you're talking about.
Yeah, maybe one could attribute that to people having multiple jobs as opposed to one job, which suggests maybe the labour market isn't quite as solid as some of the other data's telling us.
Well, I think you can always...
I'm trying to play devil's with you here because we have a view and I agree with the view, but you can't not show the other side to what
Absolutely.
You think and then we discuss it.
Well, that's why I want to go into details on this. I think you can always hypothesize about what is going on in the labour market, but I like to take a very simple approach, and rather than looking at too many different types of forward-looking indicators, just look at what is going on. Just look at the actual data. So if we break down these people in part-time employment, the Labour Department actually asks them the reasons why, and splits into non-economic reasons and economic reasons. In other words, and I'll give you the definitions because I've got them here. So according to the Labour Department, economic reasons include things like slack work, unfavorable business conditions, inability to find full-time work, or seasonal declines in demand. So that is the economic reasons. In other words,
You need to work.
you need to work. You'd like to work full-time,
But
but
can't.
for economic
Yeah.
reasons, that's all there is available to you. The non-economic reasons, which is by far the majority of these part-time workers, 80% of them, that refers to people who usually work part-time for reasons such as childcare problems, family or personal obligations, school or training, retirement, or social security limits on earnings, and other reasons.
Very interesting. So it could be a lot of women coming back into the workforce that have other responsibilities. They can only work part-time, which they were lost during the pandemic.
Look, I think the most important takeaway from this is that the majority of these people working part-time, it's a lifestyle choice.
Yes.
They want to work part-time because it suits their lifestyle. It may be that they're approaching retirement. It may be that their 401ks have gone through the roof. Their household wealth has gone up so much, they just don't need to work full-time anymore. They don't want to completely retire, so they do some part-time work. It may be women re-entering the workforce, as you say. It could be a number of reasons, but the bottom line is, when you look at this chart and you look at the blue bars and the red bars, the blue bars are the people that want to work part-time because it suits them, and the red bars are effectively
You have
the people.
to work.
That's all they can. And you can see
So
during
it's tight still. This suggests the labour market is still very tight, even with a lot of part-time jobs being created.
well, if anything, to some extent, it hints at the labour market being even tighter if people would rather work part-time than full-time. If it suits them to work part-time, it means it's going to be even harder to find people to work full-time. And
fair.
you know from the surveys, you look at these PMI surveys, and if you read some of the commentary, you still see a lot of commentary that says it's difficult to attract the right caliber of labour.
So will Powell try and ignore the strength of this report and the fact it seems to be an ascending line in job creation and still carry on with his rate cuts maybe in July, which seems to be, is it September now it's priced for, is it? Or is it July still?
It's June. We'll have another summary of economic projections, and that is the most likely meeting at which they're going to pull the trigger on a rate cut. But actually, the market now is roughly 50-50 in terms of a June rate cut. I think as far as the Fed is concerned, they really want to proceed with the rate cuts, but the economic data are pushing back at the moment and saying, well, there's not really any need to cut rates.
Listening to the Fed speak in between our last podcast and now, he doesn't sound as though he's going to get a consensus for rate cuts in the short term, unless something not dramatically changes. But if data turns softer and they can justify it, he won't get the consensus. What do you think on that?
I think that's right. I mean, let's disregard Neil Kashkari's comments from Friday because he doesn't even vote. But among the voting members, you can see the opinions diverging over the correct course of policy. And Waller, who arguably was the one
who started
he's the Fed governor, who kind of started this whole thing. Well, inflation's coming down, so we should cut rates. Otherwise, the real rate is going to be too high. He seems to have changed his tune. So you're right. They may well not get a consensus. It seems to me like the inflation data are not going their way and the labour market data are not going their way. And of course, we've got this week's CPI, which is going to be quite critical,
Agreed.
I think. And if you look at, let's just bring up the next chart. I'm focusing here on Supercore CPI. Simply because we know what's going on in the housing market with rents and OER, owners equivalent rent. If you take the shelter as a percent of core inflation, it's about a third of core inflation. And the CPI measure of rents and owners equivalent rents is quite slow moving. And not necessarily, as far as the Fed is concerned, directly affected by rates. The rest of services, so if we take the CPI services excluding housing, you could say, well, services costs, that's dependent on wage growth, and that is something that the Fed can influence with policy.
So it's represented here better in the supercore.
So the supercore is the one that we should really focus on. Plus, you've got some weird stuff going on with OER. We know they changed the methodology recently. We don't really know exactly what's going on, but they've increased the weighting of single-family homes in the sample. So here is supercore. And, you don't have to be brilliant at predicting inflation, what's going to happen with inflation. You just have to look at this chart. Supercore inflation year over year rose 4.3%, I think, in February. And if you look at this chart, if you look at the monthly increases in the supercore CPI, what you had a year ago in March, April, and especially in May and June, was some very low month-on-month increases, which are going to fall out of the one-year window over the next 4 months and be replaced by whatever happens. So if we take March, for example, where the increase was 0.2%, we're going to get the March increase in a couple of days' time. If that's higher than 0.2%, then the year-over-year
so the comps are easier to beat. Therefore, it's going to be a bigger number going forward.
Absolutely. It's going to be very, very hard for the year-over-year rate to slow down from here, with those soft prints from last year falling out of the equation.
Okay.
So I think as far as the Fed is concerned, now the forward guidance, which said 3 rate cuts this year, is beginning to look much less certain. At the end of last year, I think the Fed and the market was pretty convinced they were going to do at least 3 rate cuts. Well, now the market is pricing less than 3 rate cuts for this year.
There's the political, I won't say problem, but there's that elephant in the room, which they have to be
about that. If you look through history, at the Fed's behavior during the election year, there's no particular trend for them. For whether they move policy or they don't move policy. Some years some election cycles they do, some election cycles they don't. You can't honestly say that they completely stand to the side and do nothing.
But Powell's going to have to tread carefully on that one. But otherwise, even though he might not want to be political, he could he could cut at the wrong time and then be accused of helping Biden, and then Trump will come and bash him over the head.
Oh, without a doubt. I think he'll be accused of meddling, whatever he does. Whether he cuts rate or he doesn't cut the rates.
All right, okay. Hold on, you just said something there. If he doesn't cut rates this year, outlook for Treasuries and the S&P? Tell me.
Well, I showed previously that most Fed meetings, Powell manages to send Treasury yields lower.
Yeah,
gives a super dovish performance. The yield at the front end falls dramatically, and that propagates throughout the whole yield curve. I had thought that the market would be a little bit more intelligent than that, and the market would say, well, okay, if the Fed's going to go ahead with rate cuts, that makes the long end of the yield curve vulnerable. Long-dated treasuries should sell off. People should be more concerned about inflation.
So steeper yield curve.
A steeper yield curve. But what seems to happen is every Fed meeting, most of these Fed meetings, they drive the whole yield curve down, and then over the next few days and few weeks, it just comes all the way back because the data just don't support the rate cuts, and the market starts pricing in higher rates again. And I think just, we were discussing before the show started about precious metals and treasury yields. I think this chart is
Is gold the? I think we've said that we joked about this the other day. Is gold the canary in the gold mine, as it were?
well, I think this chart is very interesting. This was in
Oh yes,
in the weekend
yes.
note. If you look at that period from the financial crisis onwards, Treasury, this is the total return from the Treasury market, and this is a Bloomberg index of a Treasury total return index that excludes short-term Treasuries.
It takes a basket of different
Yeah,
maturities.
I think it's from 1 year onwards. So
Okay.
it's a whole basket of
Okay.
them. And you look at the total return, so it's coupons and principal payments and all the rest of it. And in that period after the financial crisis, up until the pandemic, Treasuries were giving a half decent return and gold struggled to keep pace with the returns you were getting from Treasuries because inflation was low, and if anything, the Fed was trying to get inflation higher.
Yes. Yeah.
There were these fears of secular stagnation and a deflationary environment taking hold. So up until the pandemic, that was the kind of world we were in. And then when the pandemic came,
Be careful what you wish for.
yeah, they just went pretty nuts.
Yeah,
Gave everyone 12.
Press the
every house.
button. Keep paying. Keep paying.
Yep, $1,200 stimmies out to every household in America. And you had this burst of what they thought at the time was transitory inflation, which was supply side restrictions and all the rest of it. We know the history, and obviously gold spiked, but there was still a sense that this period would pass. The Fed then hiked rates, and gold went into a kind of sideways trading pattern for a couple of years. But you can see Treasuries, the return from Treasuries has just been heading south for the last 4 years. And then gold more recently has just taken off.
So this is currency debasement. It has to be that, because you're swapping the dollar for gold, aren't you? So you want to be out the dollar for some reason. You want to be out of that particular asset into something else.
Yeah. I think
Picking a currency pair doesn't work because they're all doing the same sort of thing. They're all part of the same game.
They're following the Fed.
Yeah.
But I think it was interesting on our last show. I think I said I couldn't understand why it was that gold wasn't doing better. And then, within a few days of that, it started taking off.
You put that in your note that you went long of gold as well. You bought some upside calls and you've done quite nicely on that. So people who subscribe to the note, and you can subscribe here, www.super-macro.com. They've done well on that trade if they followed you.
Yeah, that and being short Treasuries, of course. But I think you've got to pick your poison. And those two trades are kind of the same thing. It's like you said, it's central banks going too soft on inflation. That's what's causing gold to make new highs, and Treasury, the long end of the Treasury market, to sell off.
Tell me what you're thinking about the S&P here. How do you see this fitting into all the information coming at you with respect to debasement, gold, treasuries, etc.?
Well, in a way, we know when you look at conventional yardsticks for measuring valuation, the S&P is trading at quite a rich valuation in terms of prospective PE, historic PE, whichever way you look at it, or relative to the yields from Treasuries. But
it's been difficult to make money based upon trading on that theory.
Absolutely. But I think what's happening is people really want to just be in some. If you look at these countries that really go nuts in debasing their currency, like Zimbabwe or Argentina.
Oh, you buy the stock market, you're guaranteed making money. But in local currency.
In local currency. But actually, in those stock markets, I also haven't put it in the note, but if you look at it even in dollar terms, those stock markets have done quite well in dollar terms as well. Yeah, it's quite surprising.
But that was going to be a question I wanted to ask you. Ultimately, the real test for all this game that everybody plays, extend and pretend, etc., is the currency. If the currency holds, Treasury and Treasury yields don't go ballistic, the market's going to allow governments, central banks to carry on in the same way. Is the fact the dollar isn't weaker because there's not something else to buy apart from maybe gold, which is very small in terms of a cap compared to dealing in a currency.
Well, I've got a few things to say with that. If you look at what the Chinese are doing and the Indians, but certainly the Chinese export loads of stuff to America and they get paid dollars. Now, previously, they put those dollars into treasuries. What they've been doing more recently is instead buying gold. And Bloomberg had a piece out this morning saying that the Chinese have added to their gold holdings every month for the last, I can't remember how many months.
It's been a number of years that I've been reading about the Chinese buying gold, physical gold, for reserves.
Well, I think it's really stepped up, and they've been buying far fewer treasuries lately. So I think that's something where the Chinese are saying, well, okay, we don't want to hold dollars anymore. We still want to export to the US. So we've got to recycle the dollars into something else. But to your point that all governments could be accused of some form of debasement of the currencies, where they're running high fiscal deficits and not countering the inflationary threat, that's very true. But I think at the moment, the US is probably the most obvious example of that. And so I think from my point of view, I prefer to be short of treasuries.
So if you wanted to be out the dollar, is gold the obvious choice, or is there anything else you would look at?
Well, of course, people will say cryptocurrencies, but
oh,
yeah, but we're not the experts on that.
We're not the experts on
that.
We're definitely not the experts on cryptocurrency. No. I think we might have to edit part of this because we're probably going to get some hate mail come from some.
No, let's not even talk about them.
No.
So, but I think equities, obviously, equities, precious metals.
But so far, equities haven't been really affected at all by the higher rates, which you've discussed numerous times on this show and also in your newsletter. All right, let's just play devils with you. We don't get cuts this year. Towards the end of the year, inflation starts to pick up again, and there's calls now for the Fed to start raising rates. At what level? I hate to use the word break, but what level does it become a big hurdle for equities?
I think that is when the market is very vulnerable. If the market senses that the Fed is really not going to go ahead with the rate cuts that are priced for this year, and I'm talking about any of them, then I think that's the stock market could really
okay. So net on this, it seems to me that the Fed's in a bit of a corner here. If they carry on with their forward guidance and cut rates, then the long end of the treasuries will sell off, get yields higher. And if they decide they are going to, well, maybe inflation is going to pick up the end of the year, we're not going to cut rates this year, then they start talking about raising rates. Oh my God, the stock market and everything else that's priced for perfection will sell off. What is there a way through this?
Well, you'd like to think that's the case, but the correlation between the stock market and rates market has really broken down. It's gone to almost zero, and I'm surprised by that. The other thing that like I said before, I've been surprised by is when the Fed has been incredibly dovish, the long end of the yield curve hasn't sold off. In other words, we haven't seen yields rise.
Is that the dollar maybe? The dollar's remained sort of, I wouldn't say stable, but relatively stable. If that starts to show true weakness, perhaps maybe that's where the first fireworks will start. What do you think?
Know. It's always very, very difficult to say, right, I'm looking for this or I'm looking for that as a signal that the market's going down the tubes. But I think it's just impossible to time. What you can do, and I think what people should do, I've shown this before, I've shown it in the note repeatedly, is if you want to stay long the equity market, don't do it without protection.
Yeah.
The cost of protection is so cheap now, so ridiculously cheap, and it costs, it's been a minimal drag on performance to have some downside puts in the portfolio.
Let me be clear about this. Whatever Johnny's telling you is his opinion. It's not investment advice. But if you want to see his opinions, it's www.super-macro.com. Click on that, click on the subscribe. You get a 30-day trial, and then you can figure out whether you want to take it full-time for 50 quid a month. Next week, next podcast, special guest, all the way from
Las Vegas, my favorite city.
Boom, up there.
Yes, we've got Joseph Wang, otherwise known as the Fed guy, author of Central Banking 101. And I'm really excited to have him on the show.
He's a super smart guy, isn't he?
Yes,
I'm looking forward to this as well. I'm going to get something from it, whatever happens.
I mean, we should be travelling out there to interview him.
Boom. Well, let's get BA on the phone.
But no, we'll get him on a remote link, and I'm really looking forward to it.
Okay, so everybody, that's going to be the next podcast. I just want to thank Johnny for today. Thank you very much indeed. I hope you all got something from it. And we'll see you soon.
Yep. Thank you, everyone, for listening. And remember, if you want to check out the daily notes, please have a look at www.super-macro.com. You can subscribe. You get a 30-day trial for free, and then take up the subscription if you want.
Thank you.